afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 14th of December and we have our regular Thursday guest, David Kuo, founder of The Smart Investor, coming to us out of Singapore. David, as always, great to have you on the show.
Selamat tengah hari, Brian.
Selamat tengah hari from KL. Now, David, we've got a cheer all around. Christmas has come early as the Fed signals rate cuts in 2024. We're going to get into that shortly. But first, let's take a look and see how numbers across the region stack up after that commentary from the Fed. Now, we've got the SGX, which is up 0.88%. And looking across the region, we've got the KLCI over in Malaysia. It's up 0.4%. Shanghai is up 0.24%. The ASX All Ordinaries is up a whopping 1.69%. Bucking the trend is the Nikkei, which is down 0.72%. The Hang Seng is up 1.07%. And rounding up the numbers, we've got the Kospi, which is up 1.27%. David, your view of market performance in the first half of the day?
Well, clearly, the markets are delighted by what happened last night over in New York when the Federal Reserve said they would keep interest rates on hold. But there's always one country, yeah, that spoils the party. There's always one, Japan, yeah. I mean, why couldn't Japan actually be in the green as well? And there's a simple answer to that. Japan is an exporting nation. And what happened last night when the Federal Reserve said they were going to keep interest rates on hold, the US dollar fell. Right? And it meant that the Japanese yen went up. And being an export nation, Japan doesn't really want a strong yen. It wants a weak yen, which is why it's so desperately hard trying to sort of keep interest rates as low as possible to try and maintain that to widen that differential between the yen and the US dollar. But because the US dollar fell, by implication, the Japanese yen went up. And of course, people are a little bit concerned now. They shouldn't really be, but they're a little bit concerned that Japanese exports may be affected. So unfortunately, Japan spoiled the party today.
So the messaging is perhaps three rate cuts in 2024, perhaps a lot more than many of us, many investors and market watchers have been expecting. What's your take on this? And how does this play into that whole narrative that obviously Fed policy over the last 2 years essentially looks like it's worked? They've been able to engineer a reduction in inflation. They've raised interest rates, but they've done it without killing off the economy.
I know. I mean, what an amazing feat for Jerome Powell. So you've raised a couple of questions there. So the first one is, it looks pretty much as though the rate setting committee thinks they've done enough and that inflation is still high, but it's beginning to come down and the economy is slowing down as they would like. And so on that front, everything looks okay. The market is a little ahead of itself at the moment, and they say that there should be more than 3 rate cuts. Maybe there might be 5 or 6 rate cuts next year. We'll have to see whether or not that transpires. But let's not also forget, Brian, that there was no mention whatsoever about relaxing quantitative tightening. In other words, the Federal Reserve will still be withdrawing somewhere around about sort of $95 billion US dollars a month from the US economy. In other words, it's going to be sucking this money out. It didn't really sort of mention an awful lot about that, in the sense that people were hoping that maybe it's done with quantitative tightening as well, but it's not. So even though interest rates might come down or they might be on hold until March, we have to remember that credit conditions are still going to be worse now than they were a year ago, because there's going to be less money around. So your other question, why has it worked, right? And this is a little bit of a head scratcher, but I think we can look at one word, right? I'll let you guess what the word is. And it's something that's fairly close to your health at the moment. It begins with C and it ends with D, right? It's COVID, right? The big difference this time from other occasions is COVID. What really happened during COVID was that a lot of the supply chains were disrupted, if not destroyed completely. And so that was what spurred inflation. And that was also what Jerome Powell was trying to suggest when he was talking about the spike in inflation, that it was transitory. The problem is that people think that transitory is just a few days or a few weeks or a few months. But when transitory suddenly becomes a year, then people say it's no longer transitory. But what seems to have happened this time is that, yes, demand was strong. We know there was a lot of revenge spending after COVID, and that caused an increase in demand. But at the same time, the supply side wasn't playing ball, right? Supply side wasn't actually sort of being able to keep up with demand, which was why inflation went up. So what the Federal Reserve had to do was to increase interest rates very, very quickly to try and tamp down demand, to give a chance for the supply side to be reconnected again. And that seems to have been something that has happened. The supply side is now almost back to pre-pandemic levels. So in other words, we have a kind of balanced economy. What he doesn't want to do, however, is to allow the demand side, consumers, households, to carry on spending. So in order to control inflation, he has to actually sort of keep interest rates relatively high. And that, I think, is where the market is actually jumping the gun slightly. What the market is saying is that we expect more rate cuts because inflation is coming down. But he needs to be very careful because inflation is always there. And if you don't keep a lid on inflation, it'll just come back. And he doesn't want that to happen, Brian. So the reason why it's worked this time, why he's managed to thread the needle, why he's actually managed to achieve a soft landing up till now is because of COVID. And we're getting to work through all the supply chain problems with COVID. And from now on, however, it's going to be a lot tougher because the supply chains are now in place. And he has to ensure that the demand side doesn't actually ruin the party.
And so, you, in a nutshell, you've managed to explain this complex balancing act that the Fed has had to do for the last 2 years or so, in particular. But David, over to China now. We've got some interesting developments. Obviously, China comes with its own sets of challenges. There's a real threat of deflation in China right now. Walk us through some of your thoughts in terms of China, some of the key issues that are facing China.
Well, it's two words, Brian: property market. Yeah, I mean that is really what is concerning people. The Chinese property market can account for something like half the economic activity within China, and so what seems to have happened is that because house prices are falling, households are feeling less wealthy. They shouldn't do, because as long as you still have a job, you're okay. But the problem for them is that so much of their wealth is tied up in property. And because the property market is slumping, and China is trying to find a way in which it can solve this problem. And those of us who are old enough will remember what happened in Japan back in the 1980s. Mm-hmm. They had the same problem. And are we seeing a Japanification of China? Some people are saying yes, but it really depends on what the Chinese government wants to do. Is it going to keep on bailing out the property sector? Because if it doesn't, then they're going to have a big problem. They just recently had a Politburo meeting, and the policy statements that came out were, quite honestly, really wishy-washy. I think it's wishy-washy for two reasons. First of all, they don't know what to do. And secondly, they haven't got the money to do what they want to do anyway. So I think with those two issues, the only thing they can hope for is that the property market will somehow try and work itself out, try and iron out all the wrinkles. But that, as you know, takes an awful long time. And I think that is the problem with China at the moment. They have a leadership who is very focused on what he wants to achieve. And it is because of that that any suggestions that are made that run counter to what the leadership believes is just thrown to one side. So most of us know what needs to be done. They need to have a massive fiscal policy. They need to pump money back into the economy, back into the pockets of households. But is it because they don't want to do it? Or is it because they haven't got the money to do it? And that is the question that the Chinese government will have to answer themselves.
Now, on that note, David, thank you very much for your insights. Thanks for coming on this show.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore. This has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.